I guess coming at it from the perspective of 2025 being a year where we pared back positioning in those cheaper markets where we'd managed to generate strong returns, you were then in a position coming into this year where valuations at the headline level looked quite, there was a lack of diversity. There was a situation where you've got quite neutral valuations. So when we think about where we should have our positions, principally at the overall equity level, we're slightly short. That's generated principally because we have a degree of expensiveness in the US equity market, but at the same time, we have cheaper pockets elsewhere in the world, and that's quite a diversified basket of non-US equity markets that we're able to capture that valuation dynamic. So where we hold positions, they tend to be outside of the US, and then we have a corresponding short position that leaves us slightly short equities overall, but again, fairly neutral. And that's really a reflection of the behavioral journey where market participants have got to a position where they're broadly enthusiastic about equities, not euphoric, but there's a degree of comfort of ownership, and that makes us less reluctant to take huge amounts of equity risk. And contrary to that, on the bond side, you've seen a collapse in the equity risk premium over the last few years, generating a kind of feeling for bond investors of general discomfort. It's been a bad journey for most bond investors over that period. And that leads us to a position where actually the valuations of those assets look quite positive. We're seeing good opportunities at the long end of developed government bonds. So although we look neutral at the overall level in the balanced fund on fixed income assets, what you'll find is because of the duration that we hold in the portfolio, we actually have a reasonably aggressive position in government bonds.